Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, just after the close, December 13th. What a week. After 3 years of Brexit worry and 18 months or so of China-U.S. trade worry, we got some of that concluded. Now, as we know, the Brexit process has a long way to go, and the China-U.S. trade negotiations are probably a 10-year window before we have resolution, if we ever have resolution there. Something we talk about at Cumberland is, although we look at the news and listen to news, we don't trade the China-U.S. trade agreement. We don't trade Brexit. We don't trade GDP. We don't trade economic numbers. We trade securities. So we talked last week about taking a look at some of the securities that represent asset classes and see how we might be positioned, what we might get over the next 4, 6, 8 weeks, and how we may be able to stay flexible, adjust portfolios a little bit. We have 3 charts we're going to take a look at. First one being SPY, which represents the S&P 500. Look at the movement over the last 4, 5, 6 weeks in SPY. You can see that breakout, very solid to the top of its trading range. We often hear from the media and from traders and from brokers, are we in a sell strength scenario, a buy weakness scenario? What this chart says to me, and this is just an opinion, is we want to be looking to buy weakness here. We spoke last week about resistance, which was in that 3,000 to 3,025, 30 area, becoming support on the pullback. We saw that pullback stall about 30.60 or so and move higher. When we look at this chart, what it says to me is that although we are somewhat overbought, look at the red circled weekly distribution plus 86, we're in a very healthy market environment. We want to be looking to buy some of these. If we saw a pullback in SPY to that 300, 305, thus representing 3,000, 3,050, we would lean into that. We would want to be a buyer. Where would be a buyer? Well, we have 10% cash in our U.S. Equity portfolio. We have cash in our tactical trend portfolio. So we would be able to push some more money into the equity market. It may not be in SPY. It may be in some of the sectors that are showing good relative strength versus SPY. What are those? Healthcare, dynamite, including biotech, which has been on a rip up 25% in 2 months. Have to take a look at technology. Refuses to give up its #1 relative strength spot. Semiconductors, software, very strong. So we'll continue to look to add exposure into weakness. We do have to pay attention to that 86% overbought number. As we get towards 100, we need to take our foot off the gas a little bit there. Let's take a look at the international chart. ACWX, All Country World Index ex-US. Powerful, very powerful chart. Having traded using point and figure and trend work for 25 years or so, when I get this kind of setup, which is a series, long-running series of lower tops, reversed as it has the last 4 and 5 months, that is the type of trading action that is very difficult to fall apart. Can we see ACWX fall apart? Absolutely. We never stand on ceremony. There are no absolutes in trading. But when I take a look at the All Country World Index here, very powerful setup. What will it lead to? Remains to be seen. We have to lean into the thought that we're buying weakness here. Now, international has a 10%, our international strategies has a 10% position in this security. I would lean to be adding on weakness. If we were to get a pullback, want to add. Take a look where we're at, 79% overbought on the weekly. That's not an extreme. Securities can get to 100, 125% overbought. So while we may not add here, we'll certainly be looking to buy on any kind of weakness. Let's take a look at fixed income. The Moose was on last week talking about how he has our portfolio positioned, barbelled, but leaning on the short duration, shorter maturity side. Why? Well, John went into the fact that he's looking at higher rates in the next 6, 8, 10 months. You can take a look at this 10-year yield chart, not price chart. Don't confuse it with the price of a 10-year treasury. We're looking at yield here. As you can see, back in August, September, and that 9 represents September on your chart, we're all the way down to 145 on the 10-year. John said he didn't buy that, wasn't believing the recessionary talk, shortened maturities, expecting higher rates, and now we're going to be looking for perhaps a 205, a 210, somewhere near the top, if you look on the right-hand side of that chart, near the top of the 10 years trading range. Would like to see, or I shouldn't say we'd like to see, we might expect to see 205, 210, 215 as a top end. Maybe John extends maturities. He said he'd be interested in extending duration there, trying to pick up yield. So those are some of the things we look at day to day, week to week in our trading meetings, in our investment meetings. So I would classify our outlook right now as comfortable on the equity side. We're not going to start jumping up and down because there's some preliminary trade agreements and BREXIT, which, as you know, we've been talking about. That's been an old story for 18 months. Developed markets bottomed 6 months ago and have been trading beautifully. But we have to look at not what the news is, but how the market trades on that news. So everyone have a great weekend. We'll see you next week.